Okay, good afternoon, guys. Welcome to another live trading session. Initial jobless today, so I can safely say the markets have been a little bit erratic over the last few days for sure. Lots of fundamentals now drifting into the market, a lot of technicals really kind of spooking the market, some big levels kind of being hit, especially in the downside indices. So where's it all going to end? What's going to happen? Well, I don't really think it's time to panic right now. I think there's always, when we're towards the top of the indices making new highs, there's going to be some level of profit taking. I guess the main concerns are still remaining with Russia. Obviously, the Ebola outbreak. Interesting times, guys, isn't it? But again, today we can see from the massive move in the markets yesterday on the back of the data coming out about retail sales that the fundamentals are playing a big part right now. So again, you have to understand my entire rules about the 80-20 movement of markets, that sure, the 20% of times the markets move fundamentally and really do make these quick shifts, they're still going to move between them all important 8% technical levels. So we're really seeing that battle now of what the overriding trend is in the markets and what these fundamentals mean. And certainly there's a potential huge amount of low side kind of targets to be hitting the indices, and obviously the currency has been amazing. The shifts we saw yesterday were like nothing I've seen in a long time. So a lot of volatility out there, and a lot of volatility to come at, I guess. We can go through the charts when we've gone through this presentation. So I'll just quickly run through the basics of trading fundamentals and what I think about the figure, and then we'll go through the charts, and you can ask me to analyze any particular products you want. I'll be focusing on the euro dollar, gold, and the S&P today, but anything you want to hear, guys, just do let me know. Just do a quick sound test, I guess. Sorry, I guess somebody said it if they can't hear me. You can all hear the volume correctly, can't you? Just double check. Yeah, we can all hear it perfectly. I was just double checking. All right, thank you, guys. Okay. So before I start, as always, the risk warning. Remember that spread betting and CFD trading both carry high risk or capital with the possibility of losing more than initial investment. These products may be suitable for investors only intended for people over the age of 18. Please ensure you're fully aware of the risks involved and necessary seek independent financial advice. Education only. Content of the webinar is personal opinion of the moderator, not insurer.com. The content does not constitute financial investment or tax advice. The advice discussed are specific requirement of independent financial advisor prior to entering bet. Insurer.com is not responsible and disclaims all liability for the content comments made during the session. So, economic data, what we know about it is its two main types, leading indicators and lagging. So, you have to understand that leading indicators by its name mean that, these are preliminary signs of potential becoming change to the business cycle. So, your consumer expectations, building permits, money supply. Lagging indicators, as you can imagine, take a little bit longer to filter through to the economy. Unemployment-related figures, consumer and producer price index. So, again, this is all about unemployment today. It's pretty much the opposite of non-farm payrolls. So non-farm payrolls is all about job creation. The initial jobless is all about people filing for insurance against being unemployed. So again, a real indicator of how strong the job market is. And when we talk about the US economy, absolutely huge. I was just writing some, as I do, some different things to some different people over the last week, and it just really kind of hammered home to me that we have to understand the underlying economic cycle. So although we're talking about interest rates and inflation, it really does make me laugh. It's almost comical that inflation drops because of oil prices, and people think that that's going to mean interest rates aren't going to go up. We've had 7 years pretty much of low interest rates and inflation being an absolute non-event. We haven't paid any attention to inflation if it's been high or if it's been low in 7 years. So why are we all of a sudden, over 1 month of data, are we going to start to now use inflation as an excuse not to raise interest rates? It's absolutely pathetic. So, the whole point is that everything's been rising above inflation anyway for the last 7 years by 2 or 3 times. So inflation's down means absolutely nothing. The only reason why people are relatively happy in the UK is because house prices are back to 2007, lows to the highs. So your real wages haven't kept up with inflation. So, you're not really any better off, are you, than you were 7 years in real terms. Wages have been stagnant and not gone up at all. So everything has gone up in price. So just because inflation's down now means absolutely nothing. That's why professional traders and people in the market don't look at the CPI figure. They look at the CPI X auto, and X, energy. So, X or X energy and food, because they're the most two volatile short-term factors within that figure. So professional traders don't really look at that. So just because there's been a drop in inflation doesn't mean anything really in all matter of fact. And if you think this is going to have any effect on Mark Carney's decision to raise interest rates. It isn't. I mean, it's absolutely laughable. Interest rates, again, the more we talk about it, the more fear you see in the markets. The more the markets go down, the less likely it is, I guess, that interest rates are going to go up. But it's inevitable. I mean, it just is inevitable. It doesn't matter if it's first, second, third quarter of 2015. It's going to happen. And anybody who's got any kind of debt, you don't take debt over 3, 6, 12 months, do you? You generally take it over a few years. Mortgages are over 25 years. So it doesn't make any difference when it happens, but it will happen in 2015. It's as simple as that. And it has to. And all this stuff, again, as I keep saying, house prices are just going to continue to rise. Of course they are. Of course they are. Blah, 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 blah. What have I said about all investments? You treat houses like investments, what goes up will go down. So if you treat houses like an investment, an actual commodity, then they will go down. Just like the stock markets are, just like currencies will, just like gold will. Okay, so instead of them being a place where, you know, people live, you know, build up, move up the ladder over a period of time, people flipping properties, you know, people buying for investments, then all these things are going to mount up and there's going to be an inevitable correction or crash. Yep, it's inevitable. That is just a circle of life. Economics, basic 101, supply and demand. Yep, nothing I can do to change that. Nothing the world can do to change that. And certainly nothing the government can do to change that. So what is jobless claims? Well, basically any new unemployment claims are compiled weekly to show the number of individuals who have filed for that unemployment insurance for the first time. So an increasing trend suggests that deteriorating labour market and the 4-week moving average, you know, smoothed out, and that's what we get is this figure today. So basically it's the opposite of most figures. It's a high sell for the indices. So, you know, a high non-farm payroll we would buy, but a high jobless we would sell because it's bad. You know, a number of people claiming and filing for this insurance is a sign of a weakening economy and unrest and uncertainty in the job market. So again, it's very much the opposite of most figures out there, and I wouldn't say it's the direct opposite of the non-farm payroll by any stretch of the imagination. But I mean, there's a good correlation between how the market reacts between non-farm payroll and the jobless, and we saw a 300-point movement in the euro dollar just based on retail sales. So if this is, you know, above 300,000 today, we could see some big moves in the market. That is for sure. What else do we look for? Well, we're always looking for the key data. Again, you know, that's timing in with the economic cycle we're in. And really, we're all about growth still. You know, we're still one eye on inflation, one eye on interest rates, but it's not really kind of what traders in the market are focusing on. It's still about that growth and the strength in the economy. So that's non-farm payrolls, interest rates, GDP, consumer price index, which I've already is more inflationary. So again, it's still fully fed. It's still retail sales. I mean, it's a toss-up between retail sales yesterday and doing the jobless today. So if we've done retail sales, it would have been a bigger move than probably any non-farm payroll we've seen in the last 12, 18 months. But again, it took time to filter through to the market. So it wasn't as quick as the market, you know, absorbed this information, let the first 5-minute close and then went off. It didn't really filter through to the market for really until the first couple of hours. And then the reaction after that, when the US market opened, was this extra, you know, volatility in the market. So if you're around trading that, sure, there was great opportunities to make some money, but there was massive opportunities to get absolutely destroyed. There's no risk-reward ratio that any sensible retail or even professional trader could have adopted. So if you tried to sell some spikes in the euro dollar, then I mean, it just moved too aggressive. And gold, again, gold does this over extensions and squeezes, you know, the market out, but you know, sometimes you have to just go with the market. Trying to pick the tops and the bottoms when the market's moving this aggressively are just too dangerous. So you either get on the initial move and hold on, or you just stay out, because you know, trying to pick them extremes is a very dangerous, a very, very dangerous game. So before the figure, generally see a tight range. We'll go through the charts in a minute, and we'll go through some of the technicals. There's not been a massive move in the markets before this figure, but again, all we can go off is what we know in the past. And you know, yesterday's figure caused in the hours after it was released, you know, some massive volatility. So we might not see a huge move today, but we're more likely to see a huge move after the figure today because of what happened yesterday. So again, it's building up, isn't it? What people have thought, building up an idea of what traders are. You know, if you saw this huge move in the market yesterday, wow, what caused that? Look through your economic calendar. Right, it was a bit of fundamental data. What have we got that's important today? Well, we've got, you know, initial jobless. So, right, okay, well, maybe we should focus on that because there might be an opportunity to make money. That's how markets move. That's how markets work. So there could be a bias being formed. There could be some longer term trades getting in or out based upon yesterday's movement. So again, the market's going to be focusing on this figure today because it is a very important figure from the US. So there's three ways of really trading any kind of fundamental data or news, and that's taking a position prior to the market release, setting the opposite orders outside of the range, and trading the aftermath. So the first one is taking a position for the figure. So really, I mean, you can't get away. This is just taking a guess, taking a punt, thinking your opinion is going to be more solid than perhaps the market expects. So the problems are that the volatility, as the markets get this data, there's generally a big initial spike. So it doesn't mean just because you're in a position you're going to make money. Sometimes it's very, very hard to get that profit out when the market moves very, very quickly after the market gets this data. How do you manage your stops? What happens if you're wrong? And as I've said, over the many, 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 many years I've been trading all types of fundamental data. I haven't really ever made money. I've lost just as much as I've made by taking my own opinion before the figure. Now I predicted, well over 100, 120 non-farm payrolls, and I've only ever got it right, spot on twice. Okay, and I haven't really made that much money from it. So I'm just like everyone else in the market. I'm trying not to get that start on the market. I'm not trying to out-predict the market. I just want the data to be given to me, understand how the market reacts, and then apply that and trade the markets accordingly. We've made a much more money doing that in the past than we have any other way. And, all these have been recorded live. I've only ever lost 2 non-farm payrolls. So data, when we approach it in the right way, is a very structured and very good way of being able to make money from data releases. Holding the stick at both ends is a bit more scientific. This is placing limit to open orders in and outside the range. So what we're looking for is that elastic band theory. Okay, so when the market gets this data, it spikes up or it spikes down. We're trying to get filled at the extremes of the market, and then very quickly the market extremes are hit, come back to fair value, and try and take some profit. So again, a very, very good way of trading. If you like placing orders, you like being quite scientific about the data, then again, you can stack your order book in either which one way. You can look for longs or shorts, but realistically, it's a good, solid way of trading the markets. Trading the aftermath, now this for me is real trading. This is the only real way I think you can profit consistently by trading fundamental data. What we're looking for is to have our technical side set in stone. We know support, we know resistance, we know how far the market can move, we know how far the market has moved in previous figures, previous examples of retail sales. We know how far markets have been in a range previously, yesterday's highs and lows, the week's highs and lows. We know how far a market can react within reason to data. So what we're looking for really is that first 5-minute candle to close, then to do a continuation or reversal pattern based upon what the market's already told us. Again, Fibonacci is a good tool for this, the Bollinger Bands. And all what we're trying to do is understand if the market, if we get a bad figure today, i.e. a high figure, is that going to continue to sell off in the indices? Is gold continue to hit the top? However, if we see a very good figure today, are we going to find some dip buyers, some value buyers in the stocks, people selling the highs in gold? Okay, taking advantage of that short-term, contradictory good data versus yesterday's bad data. Putting it all in context. Is Jobless better than retail sales? Is it more important to the market right now? If we're in this all-important growth economic cycle, what is more important to the US economy? People buying or people that have jobs? People don't have jobs, they don't buy. Okay, so it's a bit of a tough one to weigh. They're not like for like. But I would say after the good non-farm payrolls that did, see a bounce and a recovery in the markets, but then kind of flattened out, that if we see a worse than expected jobless today, I think we're really going to see some big technical levels, targeted in the indices. So the sellers are certainly going to push to try and push any remaining bulls out, sorry. So I'm going to share my screen now, guys, so we can go through the charts. Any products you want to go through, guys, let me know. Okay, so any particular products, any particular FX pairs or anything, just let me know. We'll go through. So I'll just show you, the reaction to the figure yesterday. So this one we got the data out. So we saw the market was already kind of, bouncing back in gold, but we saw the overextension happen later on in gold. And the market really hit these upper levels and try and get to 1,250 in gold. And now we're consolidating. So one or two things will happen today. If we get a good figure, then gold is certainly going to hit these lows at 1,238 spot 79 and try and get back into the low range. So the low range would really be the 50%. So down here. So let me just highlight that. So down at 1,235 spot 95. So we've got this small consolidation low area in gold. And remember, the trend in gold is still down. So looking at the monthlies, although we've rebounded off the Ebola crisis and bad economic data, we're still consolidating well towards the low of this down move in gold. And again, once we hit 170, as I've said previously, we're definitely going to test lower, and that $1,000 for me in gold is certainly a massive target. So go and cycle through the charts. Still, a little bit of bounce off the lows, but making lower high in the weeklies. So a natural rebound in gold was fine, but we still got the opportunity to sell high. I certainly can't say we're in a bull market in gold. Daily, again, another recovery, but I wouldn't say that we're 50% of this up move here. Okay, we're not. So we've got a little bit of time for the market still to turn and come down. And then we're going to our hourlies. Sure, we're consolidating now, but really it's getting a bit of a pennant pattern. So I would say the market's either going to, if we do get bad data technically and fundamentally, go up. But, if we get, kind of okay data, then I still think gold's got a long way to come down and get back into this spike that we saw. So gold, we've got the euro dollar. Euro dollar, a crazy, exaggerated move. I mean, I was short the euro dollar here and had to take 50 ticks offside before I got back out here. So really a one-to-one trade, not a great trade in any stretch of the imagination. But hey, these things happen. Extra volatile risk. When we've seen this candle here, you don't see many candles like this. 140 ticks, but in 3 candles we've moved 241 ticks in 3 hours. I mean, that's some significant volatility and some serious movement. You don't get to see that very often in the markets. But overall, I still don't think the euro is fixed, and I don't think the eurozone is fixed. So as much as it's spiked, we're really consolidated. And you can see how the 50% Fibonacci worked time and time again. Get to the 50%. Okay, market then really, one fake out, but then we're looking like we're going to get lower. So these are your targets to hit back down, 127 and 1265. S&P. Again, still we're seeing this big, kind of sell-off and correction, but, because the curve and the trend is so steep, of course you were going to see that correction. So if we draw the kind of trend line, that it's much steeper than you'd ever really want any trend line to be. So the fact is, we are going to get this probably quick correction and maybe, down to 1737, but the trend is still up. So, don't be fooled. We're not in a bear market by any stretch of the imagination. We've only sold off, for 16 days, and it's been a long way, but it was always going to come, wasn't it? I had some muppet arguing with me on Facebook, and I said when the correction comes, it'll be almost like flash crash style. And they said, that can't exist anymore because of this, because of that. They'll close the exchanges. These monkeys, really do wind me up because they don't have any idea what they're talking about. If you've got, so much money tied up in a bull move that when we do liquidate and we do see these big moves, you're going to see more volume. So you can't close the exchange. And if you do close the exchange, it gives confirmation the market's moving down. So people sell anyway. You can't stop a market selling off. So obviously we've seen this big correction here and go back to these technical levels down at 1836 where we're trading now. So still a little bit of down room, but we're not in a bear market yet. So I'd expect the market to consolidate, hit these levels, and maybe again test back higher. I still don't know where the safety of money is. So I would rather put my money in Google shares than Greek debt or any currencies. So the market and dip buying is still going to be, because we're still in a bull trend. Move through to the weekly chart. It's looking quite nice. Okay, so all right, we've probably broken through a weekly trend here. So we have got, downward movement. But again, it still looks the market could consolidate and still have the ability to move up. Is it just going to, suddenly break down and move all the way down here? Unlikely. And dailies again, maybe this is going to be the new trend. So don't start, maybe sell down to these lower levels. maybe 150 ticks or so more. But this is where the market's going to consolidate, I would say, around about these levels. I'll be looking to buy some bounces because the overall trend is still very, 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 very bullish. So what my basic point is that I'll still be buying any lows in the S&P based upon if we do see good data. I'd still be selling any highs in gold and selling any highs in Europe. So as simple as that, really. So we want to see the FTSE and DAX. Well, the FTSE and DAX are going to behave very similar to the S&P, but I'll bring them up, of course. So FTSE and DAX, both again, you can pretty much see the charts are identical. Where we hit these lows, market outside the Bollinger Bands come back up, but there's been a downward movement. So we were below the hourly fibs now. So very, very, again, look how this tested here, a great sell back down. So very, very important to know when we're in a down move, you want to catch these highs. But if you go look at it, both charts on the on the monthly, they look just like the S&P. We've seen this big correction where we've moved out of this upward trend. So yeah, if we break these lows on the higher time frames, then of course we're going to start seeing some fairly aggressive selling action. But of course we're going to get these bargain hunting dip buyers because the trend is still up. So pretty much every market we've seen this nice trend broken on the monthlies, but then you have to cycle through to the weeklies. Again, you tell it's a technical break. Support, resistance, a key turning point in the market. So again, you can just see these things by flicking through the higher time frames to the lower time frames. Exactly the same, kind of scenario in the in the FTSE. So where we go, again, you're going to have to use your discretion and understand, where the kind of big trends are. If you think this is the absolute high and low, then look for that 50%. So down here. So selling wise, in the DAX, we've got 7981 as a 50%. Easy. Anybody can see the market itself is going to get to there. Same scenario in the FTSE. Again, if you think this is the absolute low and that's the absolute high up here, then your 50% is just here. We're not a million miles off. So again, maybe we'll get a good solid bounce after 1, 2, 3, 4 weeks of selling from the 50%. 2 levels, weekly level and 50%. Maybe we'll break through and hold it and then see a bit of a bounce. So it's how you want to trade it, isn't it? The FTSE certainly sold off a lot more than the DAX and the S&P, but it's all relative, isn't it? So scaling through back to the dailies again, the technical brilliance. Going from your monthlies to your dailies, how the market's made its mind up and gone down, and again, quite a lot more bearish in the FTSE as we consolidated around this weekly level here and not even made it back to the trend line and then broke down. So looking at the hourlies, your big target's really short term and that 50% and 800. So if you do think the market is going to sell off in the DAX, then these are the big levels. In the FTSE, same scenario. That 50%, not a million miles away. That's your next kind of major point of attraction. And if we do test that, then we've got a weekly level below it, and then it's all the way, breaking through 6,000, maybe to 5.8, 5.189 is the next 100% fib level. So again, a lot of downside room, but don't forget we're in a bullish market. Just because the markets have sold off aggressively, in 16 days in the last kind of 3 weeks, doesn't mean we're in a bear market. We're still in a bull market in every sense of the imagination, and there's still a lot of money tied up in the market. So a lot of institutional, a lot of private investors taking money at the top of the range, but doesn't mean the markets won't then recover and go back higher. Because where's your money safe? Apple, Google, Amazon have more money than countries, so dividends are still there. But the changes to the tax, the changes to the way we live, public opinion are all really being squeezed, aren't they? You can't have Apple paying £10 million in tax when they're worth $1 trillion or whatever. You just can't have that. It's not fair on the civilized world, is it? So the figure today, guys, we were expecting 290. So the range is pretty tight. We've got 295 on the high side and 280 on the low side, a prior of 287. So I'd say anything over 300 today is a massive sell. The indices are really going to take a bit of a hammering, and gold may regain some of these consolidation points and break these highs. And very, very difficult to say, isn't it? What the market's going to do. But this is an important figure today. And with non-farm payrolls really kind of being totally disregarded now, and the retail sales affecting the market in the way we've seen it. If we see anything over 300,000 today, meaning that more people are claiming this insurance and protection against unemployment, then I would say that with the fundamentals, the Ebola, the Russia situation, the problem with oil and global demand slowing, that we're going to see, some pretty big closes towards the end of the week, towards the low. So we've got 5 minutes for the figure now, guys. So obviously, it'll be a standard buy, sell based upon the S&P, based upon the figure that I hear. Has anybody got anything they'd like to go over? Anything else they think about the figure? What do you guys think about the figure today? Do you think A is important? Do you think the market's going to be paying attention to the jobless claims today? And I would say that the range on Bloomberg is what I'm looking at. 295 on the high side, 280 on the low side, 290 expected. What does anybody think the figure will come out today? Are we expecting a higher claims or a lower claims? Okay, Roshka, no estimations for the release, just going with the flow. I like it. That's a nice steady approach, a nice mindset there. Again, as I say, it's important not to have a bias, but could be interesting just to see if anybody out there. We've got 48 people in the room. That's 48 real traders. So 48 people. Again, it's a tiny estimation of what the market sentiment could be, I guess. So no estimate from Jeff. So nobody. So Simon's looking for a chance to get in a good level. Okay, I take it you're going to talk about the FTSE, Simon. I mean, what do you think about the markets in general? Do you think the FTSE's got a longer way to go down, Simon? Do you think it's going to go down? No? You think we're going to consolidate and going to get some dip buying, Simon? Yes. Okay. Well, I'm inclined to agree with you, Simon. To be honest, I mean, I think there's so much money tied up in the stock market that obviously you've got to see a quick correction and quick amount of money being banked and profit being taken. But I still think the indices on the whole are a good investment. Yeah, absolutely, and yeah, the FTSE at a good weekly support. There's a lot of technical levels here, and that's what I said. I mean, all these kind of all the markets right now, because we have seen this volatility, have shown their hand. And again, we've hit some good high levels in gold, we've hit some good highs in the euro dollar, and we haven't held on to them. So the natural trend seems to be euro dollar was down, just coming back down. Gold again hasn't really held on to the highs, so it's got a chance to come down. And the FTSE. Again, look at these tails. A lot of tails on the bottom on these hourlies. It's looking for any excuse to hold and get back to these upper levels. Okay, in the S&P, the FTSE and DAX. So Peter's just saying anything over 300,000 panic selling will resume. No, I agree, Peter. I think short term, anything over 300,000 would see that. How's your position management? Several positions at the same time from different levels, entries and exit, or just one? Well, Roscoe, I mean, I'll see how the markets move. I mean, I've got my markets open, the ones, the charts you can see now, so I can dip into these markets very, very quickly. I'd say that any move today is going to be short and sharp, and then we'll look for the continuation or reversal, but there's certainly opportunities to get involved in the markets very, very quickly. I would suggest that you only pick one market, but I keep 3 markets open up at all times to give myself a chance, just because, if one market isn't moving, then don't trade it. There's still an opportunity to trade the S&P, gold, or the euro dollar, depending on movement, isn't there? So it doesn't really matter. If nothing moves, don't trade. If something moves and you can understand it, get on it. That's the whole point of trading. Don't be tied to one product. All right, guys, under a minute now before the figure. The call will be buy, sell. 290 is the market expectation. 280 on the low side, 290. High, sell, low, buy. Let's, be prepared for any outcome, guys. Any outcome. I would say personally, buying lows in the FTSE looks good to me, and FTSE, DAX and S&P. But let's not get biased. Let's just trade the figure. Ten seconds, guys. Get ready. 290 expected. 264, that's a buy. 264 is a buy, okay? A lot lower than expected. 264 is a buy. Look for these key levels and lows in the S&P. Remember, the market generally does the opposite for what you think first. So again, we're seeing gold taking a hammer in. Look for a bounce or break of that 50%. A 1,23595. Much better than expected jobless claims, though. Much better than expected. So again, obvious natural sell-off in gold, breaking these lower ranges, as I said. Targets are 12395 and down to the 61.8. Potentially, which is at 1232.66. Again, S&P, be careful in the S&P. We always generally see on good figures, we see a down move or opposite reaction before the market does what we expect. So be careful of buying the lows just yet. But that's a bullish sign for the S&P. Euro dollar's done nothing. It's still weighing that up. But gold and S&P, what we're looking for. So much better than expected jobless figure out right now. 267, much well outside the range. So I'd expect, to continue to see gold sell off. What we'll do is we'll just wait a little bit for these higher levels, higher time frame levels, just to come into play. Again, wow, I mean, this is the problem you see with again, fundamental information. The market knows what the short-term retail trader does, so they can do the opposite. So gold made this initial sell back, but has already recovered, half these gains and is pushing up. So be very careful, okay? Because again, the markets can go the opposite way in the short term and do the exact opposite of what you think before coming back. So I'll put the charts on the 5 minutes just to see the market initial reaction, okay? So we can see in gold, look how it's so difficult to trade gold. Much better than expected. We sell off 30 ticks and already we're looking like we could go positive. So be very careful in gold. Euro dollars really had very little reaction at all, and the S&P pretty much done nothing. But again, you're going to get a lot of people loading up long based upon that much better than expected jobless claims. So still will expect gold to come down, but again, it's going to get all the retail traders out first, and the S&P will probably do the same. So I expect the S&P maybe it will test some lower levels. I would say maybe excuse me, down to here, down to 1827, before it then bounces and goes back up. So we're looking for institutional traders, professional traders, getting retail traders out because they know everybody's selling gold and buying indices based upon. Okay, let's get back to some of these questions, guys. Definite further downside of the indices, sell rallies in my opinion. Every time I join your webinar, sound goes off intermittently. As good as your presentation, the quality sound is poor. Well, it's your connection. I've got loads of people on here that have no problem at all, so it's your connection. Sound is perfect to me, makes sense. Sounds perfect here. Absolutely, yeah. I mean, again, it's numbers, guys. It's nothing to do with our connection. So we're seeing a big coming into the euro dollar now. So you wouldn't really expect that. You'd expect the dollar to gain a little bit of strength on the back of that good US data. But again, I would be selling any highs in the euro dollar right now. It's opposite land trading, isn't it? Everything we think should be happening is doing the opposite. So this is a retail squeeze, guys. Gold now is going positive. Everybody who's short gold now is out, losing money, getting killed. Okay, so look to sell highs in gold. Yeah, so maybe 124, 180 would be a big level. Again, look for this level 182774. That's naturally where I think the market recover and sell off before we then go up. Remember, this is good data. So everything's in opposite land here. Retracement levels, again, getting back to 38, getting back to, anywhere above 1278, and a half is where Eurodollar could potentially get to. So, again, probably don't get into a trade now. Wait for the next 2 minutes and the 5 minutes to close because, again, this is just a retail squeeze, guys. So where are you going to buy if it goes up? Well, I'd say, again, that 128747 in the S&P could be a potential bounce point, and that's just going off these quick points. But daily, 1950 is a good daily level. So maybe buy here an average. It's good data. So again, you have to see how far the markets will push this before it goes in the way we mean. Yeah, absolutely, Bob. I mean, the whole point is, if you're trading off the back of data and you're trading fastest finger first, then the market, the institutional, the professional traders have more ability to move the markets in that first 5 minutes than the majority of retail traders. So what it will do is it'll get everybody sucked in and go, yeah, of course gold's going to tank on this. Get them all sucked in, then squeeze them all out, and then push the markets up while they're buying, sell the top of the market, push it down as quick as they can, and get all the retail traders back in but then they won't be able to hold on as long as the professional traders and the retail have got squeezed out so the professional can make more money. That's how trading works, guys. So a pivotal part of my book that I'm having a big argument with my editor about, saying that if everybody knows all the equations and knows what the rest of the market will do, it's rife for being manipulated in the short term. If I know that all the people in the world are going to sell gold on a good jobless, then of course the market can buy it up 50 ticks and then wait for everybody to get out and then sell it to make more money. That's how institutional works in relation to retail. So gold will make a new low by the end of the day. It has to, yeah, because it's already broken through that point of consolidation, and it's good data. Good data sells gold down. But in that 5-minute candle, every retail trader in the world has been killed, yeah, and taken out because nobody has the risk strategy to be able to deal with a 37-tick movement. So again, watch this S&P to squeeze out the retail traders, maybe the low of the 5-minute Bollinger Band, maybe a breakthrough to this low level. So what I'm saying to you is you sell by all means the FTSE and buy gold if that's what you think. But that's not what the market knows. The market knows when we get good economic data, out of line as it is, gold should continue to sell off and make new lows. The S&P indices should recover. Okay, so that is just how markets work. But in that short four and a half years I've been telling you this, and I'm not often wrong. So don't get involved now. And I wouldn't sell the S&P, even though I know it's going to get down to here. I'd rather buy at these low levels because it's the right thing to do. Sell highs in gold because it's the right thing to do. 1, 2, 3, 5, spot 9, 5 is a massive target in gold. So no decisions immediately after release. Wait and see what happens. Yes, as I've always said, wait for that first 5-minute candle to print, and then again, do a Fibonacci on it. So Fibonacci on this 5-minute candle here in gold, what we're looking for is this to be a level. Yep, so if this level, which ties in my 50% breaks and holds below, we're going to make a new low in gold. S&P, we haven't really seen much of reaction, to be honest, in the 5 minutes. So I just leave it. But short term, we've gone from the lows to the highs. So that 50% here is going to be a target. This is a target I can tell for myself. So if the market does break these lows, then, again, what I'm looking for is that 50% to hold and be, a quick action point and then make new highs because it's good data. Yes, Stephen, I do use pivot points, and these are pivot points here on my charts. These are 5-minute pivots, and you're looking at the euro dollar. So my euro dollar 5-minute pivots are here. Yep, so this is the short-term support, resistance on the 5. I mean, the 15 minutes are probably a little bit more. Yeah, there we go. 15 minutes are a lot more accurate. So support on the 15-minute pivot, broke through resistance pivot. You didn't get as high as the R2 pivot, so we're in the range. But, again, market spiked up. We're still looking fairly bullish in the euro. But, I mean, that is good data, so that really should bring the euro down versus the dollar because it's good, strong US data. So, again, I'd be selling any highs, consolidating gold. The right thing to do is for the euro to make new lows, the gold to make new lows. And, again, S&P is breaking through these levels. So, again, expect any major level that you'd expect a bounce to break. So instead of buying the 50%, as I said, I would say 1287 is where the market can push to. So buy lower around there, or maybe even down here, at 1189 before you start buying, because the market's going to aggressively push people out. Because everybody knows how data reacts. Everybody knows, you buy on strong data, sell on bad data. This is strong data. So the majority of retail traders that are still in these, long positions in the S&P, and short position in gold are going to get manipulated and squeezed around for the next 10, 15, 20 minutes before gold does exactly what we think, makes new low, and the S&P should bounce significantly off lower levels. So see how we react to this level. I put it in when before we started trading. So 1827.47. That looks like a natural point for the market to try and break for me. So if we do see break it, we'll see a quick break of the low end of the Bollinger Band, probably to here, maybe to here, but then close here and then go on to make not new highs, but get back into the range for sure. Okay, well, the whole point of this is that I'm sat here as you are. You've listened to the same information I have. Okay, so if you hear that Jobless claims is better than expected, then you're going to sell gold and buy the S&P. So I know that. The hedge fund managers know that. Institutions know that. Big traders know that. So they know you as the retail trader are going to get short gold along the S&P. So in the short term, and that could be 5, 10, 15 minutes, 1 hour, are going to push the market in the opposite direction to get your money out. And then, when they've done that, they're going to turn and reverse and do exactly what the market anticipated and make them new lows. What we're seeing in gold now. So gold is going to make new lows and get to 1235.96. The S&P is going to continue to go lower because we're in a downtrend, but when we hit the absolute lows where people think the market can't go any further, like here, we'll probably break a little bit lower, and then all the institutional traders will buy back their position to push the market back up, because that's what should happen. That's what people are anticipating. They're looking weak after port open by around them regions. Do you know what, Roger? I generally stay away from the Dow. It is just, I've just never had a good experience in the Dow. And there's a couple of phrases in trading that I'll just bring to the table here, Roger. You pick bottoms, you get smelly fingers, okay? Or you catch pianos, yeah, you get dead. So these are some very famous sayings in trading. When you see these markets really correct as that, and I'm not saying for one instance that, you know, there isn't value low down, but you have to understand that these, I can pick all these levels out for fun. Okay, so this is naturally where the market should find some support, but it's breaking through because it knows people will buy. So look for the next level. So whatever you think is a good target region, and you've given yourself a lot of space there from 778 to 690, maybe just go that little bit further. Yeah, because the markets are going to push out that little bit further. Okay. Yeah, absolutely, extreme to extreme. So I'd say, you know, if your first buy is at, you know, 15,778, then yeah, be looking more the 15,960 before you get involved, because it's more likely the levels will break and then go to the next level, and there'll be a target point. So what I'm saying is, you know, buy the later level. So as I said, we broke through that level that I said was a key point of natural support. So we don't buy it because we know the market's going to break out. The market's breaking levels rather than bouncing. So look for the 100% naturally. That can't hold. So your next point would generally be 1819 spot 50. That's where I'd buy. So I'd want to buy here as a retail trader. This looks like good value in the S&P, but I can't because the markets are too strong. So realistically, you've got to buy 50 ticks lower to get your value. That's how the markets work. Gold again looking to hit these lower values. There's no way it's going to hold on to this wick here. So again, you're going to see these levels probably broken. That 1235 level looks quite tasty. Okay, so Manesh is saying, do you think good jobs data, less chance of money stimulus resulting from a further sell-off? Well, I mean, it's hard to say, Manesh. I mean, the trouble is quantitative easing is ending. It's ending this month and it's ending. I don't think it's going to come back anytime soon. So we've had good non-farm payrolls, we've had bad retail sales, and good jobless. So really it's nothing, is it? The market's just back to how it was, status quo. We haven't really had any significant good or bad news. It's all kind of sold off. What we're not going to do, you know, what we can't do is continue to put money into the economy that doesn't exist, and we can't continue to run, you know, artificial market scenarios and markets that don't, you know, function properly. You know, we're trying to get back to normalization. We're trying to have, you know, reasonable interest rates so people can save and control inflation and make sure we've got a balanced economy. We can't keep propping it up with you know, invented money, because the whole thing will collapse. So really, what we're seeing is a bit of a short squeeze in the S&P because we've got a natural down, you know, selling couple of days. So what the market will do is overextend to the low point before buying value, or buy value lower, knowing that it's got more ability to squeeze retail traders out of longs. Simple. So is it ideal then to have two orders, say buy order in the FTSE, close when profitable, sell order, just do the same to maximize your return? Yeah, Roll, I mean, that's a potential, to be honest. But I mean, what you're trying to do really is take the emotion out of it. So let everybody who's in the first 5 minutes selling, you know, selling gold, get squeezed out, and then get involved later. So let the markets calm down and then pick your trend. If you think gold's going to go up from this point, then you've got your level here. I've told you the level. It's 1238.79. So if gold's going to continue to go up and ignore that good data, that's a good place to buy. Get back into the range. You know, the S&P, I've said it's going to overextend below this level, yeah, and get lower. But if it starts to close above, you know, 1827.47, then buy it. You know, you've got the fear taken out of the markets now. You've got the squeeze already happened. So buy it second time around. Don't take all this pain on board. Yeah? took it to the lower bowl, as I said, didn't get to 100%, so we closed above this level here, then the market's got 1, 2, 3, 4, 5, 6 down candles on this 5 minute to go at. So maybe it'll get back to the upper levels. What you're always trying to do is outguess the market and try and get involved in real value. So the real value on the high side is up here. Yeah, it doesn't mean the market can't continue lower. There's still value buying it, but it's trying to pick the right point. Yeah, I mean, Ian's exactly right. There's no guaranteed way in these things, and putting orders into buy lows, at these lower levels. Again, what's the point of being a manual trader if you don't trade manually? Putting orders in, you have to know where the market's going to go beforehand. There's no way of second guessing it. If you want to be involved in the orders, then they need to be, in this initial spike. So you need your low order to be here, so you get filled and get your profit out up here. But that 5 minutes is gone. You can't expect, the market to come down here and put your orders in now and them still be relevant. You're looking for that initial spike. That's the whole point of stacking the order book. They have to be kind of filled and outed within the first 5 minutes. Yeah, I mean, again, Ian and John, are very, veterans of the room. There's no easy ways in trading, Roland. So there's nothing, that says put orders in and you're going to guarantee to make money. That's why I said you can trade before, you can trade the order book, or you can trade now, real aftermath. So again, I mean, the trade is still to be selling the S&P, even though it should be going up, but I don't want to do that. So I'm looking to buy extremes. And the extremes are not the low here, are here, I've told you. So the S&P, I would not be buying the S&P until we hit this level here or this level here. Yeah, just because it's the right thing to do. So I'll let the market overextend and go down, and I'll buy dips. Buy dips at 1819, 1811, and if they don't get there, I won't trade. Simple as that. You don't have to make money off every bit of fundamental data. I still think gold is going to come down, hit these lower levels, and get to 123 spot 95, but it's trying to find the right way. I'd rather sell a break at this level here to break here to get out here. Okay, so I'd sell gold and buy S&P, but only at the extremes. Okay, guys, any thoughts, any questions, anything you'd like to ask, anything that you'd like to go through? Very good question, Alistair. How long are you holding your trades on average, minutes, hours, days, weeks? I'm always intraday, Alistair. So I would say my trades are never more than a full trading day, but I would say on average probably 2 or 3 hourly closes I'll allow for my trading, so I trade off the hourly charts. So probably 3 hours maximum these days. But if it's very, very volatile, probably 4 15-minute closes. So I'll close my position within an hour or let it run for 3 hours. That's how I trade these days. Yes, no worries, Alistair. I mean, again, that's a very, very insightful question. So for your first time, that's a great question. Absolutely. I mean, again, it depends what time frames you're looking at. I look for the hourly signals, so I'll trade off the 15 minutes. So every 4 15-minute candles, you get an hourly close. But if you get a 15-minute spike or a big spike, you can always take your profit and get back in. It's all about not leaving money on the table in these markets. They're so quick to retrace that you want to get in and get your money out. So it all depends on what you're trying to achieve. Do you also trade in the evening, night, forex, for example, just in the main time? Just in the main time, Ben. So when the markets are open, I do have a number of signals, and I do have a number of EAs that I do. So they trade 24/7, and they will be a lot longer term trades, maybe a couple of days at a time. But they're absolutely minimum size you can trade, and these are meant to be much more technical based strategies, so they need a lot more time to move in the markets. I'm looking for the average of a 50 to 80 tick pip winner versus a 30 tick loser. So I do have EA signals that run 24/7, but for day trading, for intraday trading, for trading as I do normally, I won't hold a trade more than generally 3 hours or certainly 1 day. So there's enough money, $4 trillion to trade every single day on the forex markets alone. That's enough money for me to get in and out of the S&P, gold, or the currency markets. So generally looking for that bit of momentum. So what you're looking for, these highs. So selling the 50% here. So know you're right. 1, 2, 3, 4, 5. Get your money out here before the day closes. Again, then you see the big moves then happen. But again, 20 to 50 ticks is all I'm ever looking for. So that's it's 120 ticks here. You know what I mean? I'm only ever looking for. Oh no, sorry, it's a 5 minute, isn't it? Sorry. what I'm looking for is these high points. Yes, you sell the 50% here, so you'd hold it for 3 hours. Or maybe, from your 50% to your low points, you're making 50 ticks. Maybe if you're lucky, 70 ticks, 100 ticks. I'm not ever looking for more than like 30 to 50 ticks, really, on intraday trading. Just get in. So, like, test you, tries to squeeze you out, closes, then you make money. So you've got to hold it for, 3 hours before you make your money. So really, 3-4 hours when you're hourly trading is optimal. But, again, selling the high, 1-2, then you come down. So it's very difficult in these markets to make good money intraday. So I'd say between your 20, 30 to 50 ticks is what you're always looking for, because the markets can only give you what they can give you. And if you want to hold trades for days, fine. Look at the dailies. You can make loads of money. You sell here, bang. You've got loads of downside room. But there's a difference between day trading, and trading longer term, trading or investing. I look at it. If I'm investing my time, I want to see my money every day. If I'm, investing for the long term, I'm going to have to hold it for them longer periods. So John's saying, for example, I'm currently short, 2 shorts in gold. One is now positive, one's a loss. What I do is simple: hold on for a profit, or when it stops, basically to break even, you take money out. Common sense, absolutely, John. So, you know as well as I do that you have to hold on, that it's good data. Gold's broken the low end of the range. Retail traders are taking their profit quickly, but the institutional traders are knowing that the low targets are down. So you've averaged into your position, John, round about here, I would guess. So a good point. So what you're looking for is new low to be made, take some profit out here, so you protected yourself. You've gone in with 2 trades to average out your position. You're not with 1 trade and a specific stop. You're putting 1 trade on, then average at a better level, which is generally higher up the range, to average out, and then taking your profit, double it at the bottom. So, you're just doing a break even and a trailing stop. Well, I mean, it's the same thing in essence. You're letting, your downside trade higher up in the market protect your stop. So, you trail or you have a fixed stop for break even, that's fine. But, what you've allowed yourself to do is not be tied to 1 position and 1 stop. You've allowed to take another position, and that average has protected your overall position. So that's why I generally say to you is always take a smaller trade to start with, because then you can build a position. So if you take a short here and the market goes to here, you take another short. By the time it gets down to here, you're back evening out your position. So if we do make the new lows, then again you protected yourself by trading smaller size over a number of prices, rather than trading bigger size at 1 price and having a fixed 5, 10, 15 tick stop. So why am I trading 5 minutes, not 1 hour or 4? Well, I'm just showing you how the markets are moving in the 5 minutes. If you look at the gold now, you can see we've had that initial spike, but then the market is again consolidating, is looking to move lower. If you look at that on an hourly chart, you don't see that, do you? You just see the market's gone from the low, back to the high, back down to the low. Okay, so you're looking at different time frames for what you want to get out of it, and your 5 minute obviously shows you what's happening in smaller time frames and in closer to real time. So 1, 2, 3 rejections on the 5 minute of a low, so that back to that 1,827.47 level. So maybe that's a point. If we close above, the market can get some strength and some short-term resistance. As gold goes down, it should push the S&P up. So a bullish signal, potentially a bullish signal. We're talking about the S&P. Do you think the Philly Fed has significant impact on the market in 1 hour? Absolutely, Ben. Yeah, the Philly Fed, again, is another sentiment figure, and very well respected. So the Philly Fed and the Michigan figures are very, very powerful in the markets right now. So I'd say that definitely if we get another good figure, we could see a continued sell-off in gold, and the S&P could find a little bit of short-term support and bounce up higher. But again, if the figure is less than expected, we could see all these markets reverse. So gold for me, again, very, very hard to trade gold with any kind of real stop. There's a lot of institutions and hedge funds trading it, so the moves are just too extreme. It's very hard to give a reasonable stop. But once gold hits this point here, 1, 2, 3, 6, 80 at the bottom, then this is your target, John. 1, 2, 3, 9, 5. That's that. We might see a good bounce off that, but that's where you'd definitely look to take some profit. Okay, guys, well, again, it just goes to show, doesn't it, that all information is powerful in the markets, and you have to be able to trade technically and balance up your fundamental views. Do take some screen prints if you want of these levels, guys. These are certainly where the market, are going to find some good extremes. And that's it. Anything else you'd like to ask, guys? Any other thoughts? Any other final questions? So, John, with the stocks heading down, the market's at currently a high alert, watching all figs coming out. Yeah, absolutely, John. Absolutely. Again, fundamental data, you cannot ignore it. You cannot fade it. You cannot purely be a technical trader. You have to balance up your view of the fundamental and technicals. All right, guys. Well, again, take a screen print. Again, we're going. Hopefully, these might be the lows, and again, going into Philly Fed, we might see a bit of strength come back into the S&P. Gold, again, I would say these low levels and 123.95 is certainly a massive point of attraction. And again, the trend in gold is still down. The trend is in the euro is still down, so I'd still be looking to sell high points. The trend in the indices is still up, although short-term down, so much more difficult to interpret. So do not stay in your long or shorts in the indices for too long, because you want to bank that all-important profit. No problem, guys. Well, listen, again, just Google Steve Ruffley. There's plenty of interesting stuff out there that you want to read. And anything else, guys, sruffley@tradermaker.com. Do send me an email. All right, been an absolute pleasure. All right, guys, take it easy.